Hi, I'm Joe Correa, and I'm the president of Finity Mortgage. I'm going to explain to you what the digital HELOC is all about. I personally got a digital HELOC and I closed in 4 days, and I have an 11% interest rate, and I was approved for $170,000. And I'm only required to make interest payments. So I thought that was a very good opportunity. Plus, I have funds available in case of an emergency or in case I want to invest those funds. Now, I did use part of those funds to pay off debt. So you are allowed to use the money to pay off debts. You're allowed to use that money to improve your home, or you can use that money for whatever you want, really. If you want to take a vacation and then have the rest of the money available for investment purposes, that's perfectly fine as well, because it is your home's equity. Okay, so when it comes down to the HELOC works just like a credit card, okay? But you're drawing from the equity of your home. In this case, let's say you have a $500,000 home and you get a $100,000 line of credit. Let's say you owe another $200,000 on your mortgage. So it'd be total $300,000 that you would owe on the home. Now, of those $100,000, how would you even get approved? The minimum credit score that you need is to have at least a 640 credit score. Second, you don't need an appraisal up to $750,000. So if you get a home equity line of credit, what's going to happen is the computer is going to do an automated valuation, and it's going to figure out exactly how much your property is worth in general. And if it comes back a little bit lower, then you can still ask them to review it again, and they will do that for you. Now, in my case, I closed in 4 days, and all I needed to provide was my driver's license and a copy of my mortgage statement. So they knew exactly how much I owed and what my payments were for that. Next, when it comes to the credit, when they review your credit, it's initially only a soft pull. So a soft pull doesn't affect your credit score. So you'll be fine when it comes to that, but at least they have an idea as to if you qualify or not. Once you do receive an offer, which will happen in a few hours or sometimes less than that, then you are able to accept the offer. Let's say they tell you that you applied for $100,000 and they tell you that you're approved up to $150,000. That's exactly what happened to me. I applied for $150,000 and they offered me $170,000. So I accepted $170,000. And when that happens, then all you need to do is you will get two different options. You will either upload your tax returns or W-2 or pay stubs, or there's the default option where you connect your bank account and the automated system will add up any and all deposits in your personal bank account. You're not allowed to use a business bank account, by the way. Simply just part of how it works. So on your personal bank account, it'll add up all your deposits. So let's say you have $10,000 in deposits. That's what the automated system will use to qualify you in terms of your income. So you don't even have to provide tax returns, pay stubs, or W-2s if you have those deposits in your bank account. And then that way you can qualify that way. Also, I do want to mention, if there's somebody else on your bank account, they will divide that income by 2. So if you have somebody in your bank account and they don't want to be in that bank account, you can remove them from that bank account and then apply for the loan, and then you'll use the full 100%. If not, you can also have them included in the loan, and then that way you can use 100% of the deposits. So this type of loan is incredible. I know no other bank offers this. So this is something truly special. Now let's go over how the draw period works. So for the first 5 years, you're allowed to take money out and pay it back. Take it out, pay it back, just like a credit card, as many times as you want. And initially, you're going to get checks in the mail to be able to use those funds. And at closing, you'll actually get the money wired to your bank account, whichever bank account you provided at the beginning to verify your deposits, if that's what you wanted. If not, you can still provide your bank account information. And then after that, you can make interest-only payments for the first 5 to 10 years. And those interest-only payments are, again, based off the interest rate, which will be the margin plus the index. And in most cases, it's probably most cases because it's a second mortgage, it's not going to be a lower interest rate. It's going to be a little bit higher since there's higher risk for the lender. So that's anywhere from 9 to 11%, sometimes 8%, sometimes 12%, but in general, 9 to 11%. And you're going to make interest only payments for the first 5 to 10 years. If you want to make principal and interest, you're allowed to, and you can go ahead and do that at any moment, either parts of small amounts, or you can pay the entire amount off. Now, when it comes to the interest, you're going to pay for the first 5 to 10 years. And then after the 10th year, you're going to have a fully amortizing payment, which will mean you'll be required to pay principal as well. And this is for a 25-year period. So it becomes a 25-year mortgage. So initially, for the first 5 or 10 years, you're going to have interest only. It's pretty easy, pretty simple to calculate. You're simply going to calculate whatever the amount is, let's say $100,000 times 0.10, which would be 10%. That would be $1,000 divided by 12, which would be on a monthly basis, which is what you're required to pay. So in that case, for 12% of $1,000, this would be just under $100 would be what you would be required to pay on a monthly basis, which is not very much for $100,000. So that's why it's such a big benefit. And you can use these funds for whatever you want. Okay, you'll have 3 options. You'll have the option to either pay with, you can use those funds to pay off debts. You can use them to improve your home improvement. And the last option is to actually use it for whatever you want. Okay, so you don't have to pay debts. You can just have the money available and invest it. And for the next part, I also want to mention that there is an annual fee of $150, which is very common. Even credit cards have that, okay? But you're getting $100,000 or up to $750,000. So that's how it works. Now, a lot of you might be asking yourselves, well, it sounds like this seems all very simple, but when it comes down to it, how much will I get approved for? Well, let me show you now on my computer. I'm going to show you how you apply, how the process works. The application takes, I think I completed it in less than a minute, because you just have to put your name, your address, your email address, your phone number, some basic information. And then with that, it automatically triggers exactly how much the value of your home is and how much would be the initial offer without verifying your income. And then once they send you the offer and you accept the offer, then you would upload your income or use the account where you're able to connect your bank account, and the automated system will add all your deposits to save you time. And you upload your driver's license and your mortgage statement, and you're done. That's what I did, and I got approved for $170,000. Sometimes you'll get asked for your insurance statement or your HOA if there's an HOA, but many times you're not asked to do that. Now, this type of program does allow you to do this on homes that you have that are your primary residence, which means that you live there. You can do this for second homes, and you can do this for investment properties. Okay. And it basically goes to being able to calculate how much you're allowed to owe on each type of property. So in general, I know I'm going over these things verbally, but sometimes it's easier to hear somebody tell you about it instead of having to read it and then interpret the information. So for your primary residence, you can finance up to 80%. So let's say your home's worth $1 million, you can finance up to $800,000, including your primary or first mortgage. So you can get a home equity line of credit that covers that gap up to $800,000.